it's been challenging. It really all revolves around people, but
Right.
also, building out the processes. I mean, we had to start everything from scratch. So that's been difficult and just time consuming. And I mean, this is probably the absolute worst time to start a property management company business because it's just so difficult to operate, multifamily real estate right now.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi, everyone. I'm Jason Ballara, and this is the Know Your Why podcast. Today, I'm here with David Lilley. David began his real estate investing in 2013 with the purchase of a single-family rental, and then was drawn to the economies of scale inherent to multifamily. So a lot of interesting stuff in your bio, David. As I mentioned, I think it's much better to hear that in your words. So first, I'll just say thank you for taking the time out. Thanks for coming on the show today.
My pleasure. Yeah, thanks for having me on.
Absolutely. Well, let's hear your background. Kind of how you went from single family to multifamily, and then we'll just kind of dive in from there.
Yeah. So joined the Marine Corps out of high school, served 4 years, came back, pursued the firefighter paramedic route, and then I had always just been drawn to really just investing. Making the idea to make your money work for you. So as soon as I got that full time job, literally 3 months later, I was closing on my first house. I always saw renting at the time, especially just throwing money away. I'd rather pay down my own mortgage than someone else's. So bought that first house. I was leveraging a VA loan, so zero down. I think I was out of pocket $3,000 on that house because I got some, seller to cover some closing costs and things like that. So fast forward a year and a half later, I was renting that house out and then, buying my second house, still a firefighter. So that was kind of my plan, had a decent job. I'd build a rental portfolio over time. And then come 2016, I had the opportunity to leave the fire department and take a job working under the State Department doing diplomatic security, making some really good money. And when I was deployed, I wasn't spending anything. I wasn't married at the time, no kids. So I just was able to save a bunch of money. And that's what enabled me to buy that first 6 unit property in Tampa. So purchased that in 2018. 2 months later, we were closing on another 16 units in Phoenix Metro, and then we just continued to buy bigger and bigger properties from then on.
So, were you deployed when you were buying those, or that you were back in?
Yes and no. So I was in a unique situation with work that, I would work 105 days on, and then I'd be off for 35 days. So on the days I was off, I had nothing to do but look for real estate deals and pursue investments. So I can't remember. I think I think I closed on a couple sales when I was overseas, but I'm not sure that I did any acquisitions. But I kind of went back and forth until 2019. 2019 is when I did my last rotation right before my daughter was born in November, my first kid. And then so I hung up that line of work and just went full-time real estate investor into 2019.
Okay, no, that's amazing, and thank you for your service.
It's a privilege. Thank you.
When so you started, kind of the smaller multifamily. People listening may or may not know, but once we get over 5 units, we're technically talking commercial real estate. But
Yep.
but people think of 6 unit and 16 unit maybe as smaller. I think there's sort of opportunity at really any size in terms
I would
of
agree.
that, and it's a good way to kind of get into the industry and learn. How did you, in that beginning, how did you sort of approach that? Were you managing yourself? What was your take? And
Those first couple properties, and especially being that they were out of state, we used third-party management. So everything else, was my burden. I was the only, so I founded the company in in 2017. I was the only full-time employee until 2022, beginning of 22. So I was doing everything, asset management, construction management, all of the above, and really I learned by reading everything that I could initially, and then just by doing, by just going through the motions, taking a little bit of risk.
Yeah. Yeah. And I think that's really, I mean, it's a way a lot of people do it, but it makes a lot of sense. You've got to learn somehow, and the best way to learn is, by doing. And so just stepping in
Yeah.
and taking that action. As you were, sort of growing, you went from 6 to 16. How did you, I want to, maybe you'll talk through kind of the scaling process
Hmm.
over time. How did you
Yeah.
approach that and, sort of take that to a bigger and bigger company?
Yeah. Yeah. So the first, I mean, really, it was all a matter of what I felt like we could accomplish in terms of raising equity. The first raise was 350K, and I put up 200 of that. The second was 450,000, so an incremental difference, and we almost didn't close that one. That's how tough that raise was. I ended
Yeah.
up having to take out. I was carrying like 50K on a 0% interest credit card.
Yeah.
I took out a 50,000 personal loan, made my wife do the same thing. So we got we got creative, but fortunately we sold that deal 19 months later and made a great return. So it worked out. But yeah, taking some risk early on helped out. But yeah, I mean, even to this day, it's really a matter of equity. So I mean, I don't come from a wealthy background, or I've had to build out my entire network since I started. I didn't have some rich uncles that I could go to for a couple million. Our average, I think our average investment right now is probably 125,000, something like that, out of the 300 active positions we have right now. So it's just been a slow, steady growth, based off how much equity we can raise, essentially.
Yeah. And so it's a great point, right? Because it, ultimately, is if you're syndicating, you've got to bring that equity to it. And a lot of
Hmm.
times in the beginning, a lot of it is our own. It was same for me. It was kind of like, well, how do I make this work? I guess I gotta put some money in here. Um, so that's actually kind of a great question to ask then. So the growth of the portfolio, meaning numbers of units, is dependent on the equity that you can raise. So how did you grow that? How did you grow, so your ability to raise more and more equity?
Yeah. I think the thing that was the most helpful is having a track record, executing deals, having some full cycle deals. So at this point, we have six out of 10 properties that we've bought to this day. So that's helped tremendously. Having some actual results that you can point to, and the other is just continually showing up and doing the work. Hitting the conferences, making the phone calls. Making a concerted effort to build out your network. So, and we've done, branched out and worked with some fund to fund groups lately. So that's helped. Bringing their network in on deals and things like that. So that's been really helpful. It's probably the most time consuming component of this business is finding the money. It takes just an insane amount of time.
Yeah, yeah, especially right now in today's
Yeah, yeah.
market is different than it was, 2 and 3 years ago, in terms of raising capital.
Hmm.
As you grew the business, you're developing the capital raising portion, but you also, you took property management in house. You sort of vertically integrated that.
Yeah.
How was that transition? When did you decide to do that in terms of, portfolio size and timing, and how did you make it happen?
I believe we were right over 200 units at the time. So this was beginning of 22. And that really the first 2 years was a struggle until, um, those first critical hires, the management team, the corporate management team of the property management company was rough. The first couple didn't work out for whatever reason. And now, we finally got some great people on the corporate team, essentially running the property management company. So it's been challenging. It really all revolves around people, but
Right.
also, building out the processes. I mean, we had to start everything from scratch. So that's been difficult and just time consuming. And I mean, this is probably the absolute worst time to start a property management company business because it's just so difficult to operate, multifamily real estate right now. But I mean, we're going to come out on the other side knowing, being a lot better, and having learned a lot. So
Yeah.
it's been good.
I've heard people say before that 1,000 units is like the right time to take property management in-house, and but I've also talked to other people that are, sort of similar to what you did. They either
Mhm.
did it right in the beginning or they started earlier than that. What would you say? Obviously it's a hard business. Property management, I think, is just a hard business. And it's a hard
Yeah.
business if you're bringing it in house and running that particular business, but it's also
Mhm.
hard to be, kind of the asset manager and overseeing third party property management. So
That's the
you're
problem, and that's what I would say. If you see, I don't have any partners in Reap Capital. It's just me, so I don't have any partners in the management company either. So I've had to wear the founder CEO hat for three companies now, and I just did not have the bandwidth to be COO and president of the property management company also. So I would say, if you were a part of a company and there were a couple different partners, and it could be your role to just focus on property management, lead that company and that team of people, I would say, I mean, just do it whenever you feel like it. Really, don't wait till 1,000 units. But if you were like me and you needed to hire, that position to run the company, then yeah, having fee income coming in from 1,000 units would make it a lot easier, than starting at 200. Because we built out that side of the business pretty quick. So the first year I think we were in the red 100K. So I came out of pocket just to make sure we had all the people to function the way a property management company should.
Yeah. You mentioned it's a people business, and it very much is. It's
Yeah.
they are the property management team, whether it's in house or third party property management. I mean, their whole the real purpose of it is to create a enjoyable or at least manageable
Community.
community for your residents. And so,
Yeah.
and that it's an extremely important position. And I think a lot of times it gets, sort of property managers get bashed, but I do think that developing that relationship with them, whether it's vertically integrated or a third party, you've got to be
Hmm.
able to recognize what the challenges are there and support that.
Yeah.
With as you've grown, you said that the first few on the corporate side, the first few hires on the corporate side didn't work out.
Hmm.
What would you say for people that are, considering this? What types of things do you look out for in terms of trying to scale a business in general? As you mentioned, you're looking at equity, the ability to raise equity on the actual acquisition side of things, but then if you're bringing property management in house, what are you doing at that point to scale that business?
Hmm. I think one of the things that helped us out a lot was the fact that we were able to get through deals quickly. The first across our first, I think, four exits, our average hold period was 2 years. So we were in and out very fast. We had a lot of liquidity, so that helped. It helped us grow the business. We went from 0 to 12 corporate employees in 2 years. So we grew a ton, and we were able to do that because we had sufficient liquidity. So I mean, that's going to be key. Absolutely.
Yeah. Yeah, I think there's a lot of a lot of the challenges being experienced in the market are related to exactly what you just said, is kind of liquidity and cash flow. People people got excited. The market was hot. Let's buy as much
Yeah,
as we possibly can,
yeah,
but without necessarily the reason why liquidity and cash flow become so important, and why these deals really need to have a key principle involved, is for market shifts like we've experienced right now. It's like suddenly
yeah.
that's got to come from somewhere. And so yeah, it's a lesson that I think a lot of people are learning the hard way. So I'm glad that you pointed that out, that and if you I'm a big fan of like Alex Harmosi's content, like people that have built a lot of businesses, or have maybe not a lot, but like are really the thought leaders in that space. Like
Hmm.
I've heard a number of people talk about, that your first metric as a business owner really needs to be cash flow, and you can add liquidity
They're not
into that.
wrong. Yeah.
Yeah, yeah. And so it's when that's not there, it's a challenge. And so it's a good lesson. We all have to take the hard times, take our lumps, and then hopefully learn from that, and kind of bring that forward in business. And the idea is, liquidity reserves, kind of managing cash flow as kind of the number one metric is going to be that might be in cash flow. I mean that differently than what we refer to as, sort of that cash on cash return for
Yeah.
investors. The cash flow in running a business means you have money to cover expenses and then some, kind of, that's ultimately.
Yeah, yeah. I don't think everyone's individual path is definitely not going to be the same. You're just going to have to, like for me, it worked. It played in my favor that I was working overseas and able to rotate in and out. That I was able to save money to get me through, those first couple of years, kind of just splitting time. But yeah, I think everyone's path is going to be different. You're just going to have to evaluate, what's going to work for you specifically.
Yeah, yeah, absolutely. It's a great point that your particular position as you come into real estate, if you're going to be, especially whether you're going to be active or passive, but especially active, on the active side, these are the things that have to be managed. This is the stuff that as a passive investor, you don't have to do. You don't have to manage the business operations and the cash flow and the liquidity, but you do. You're obviously impacted by it. So
Yeah.
in your growth, you've kind of, hopefully, we're sort of seeing a turnaround in the market soon, or we will see a turnaround in the market soon. What's your plan kind of on the horizon for you as you grow?
Just continue to build out the team. So, hire as many quality people as possible. And, the way I've approached it as much as I can is to hire people within my network. So people that I've known for years that I know, number one, I can trust that person without a doubt.
Mm-hmm.
And then I can train the skill. That's not a problem. But, so, hire the character, train the skill is kind of my mindset. But yeah, just grow. We're really focused on the next 6 months. I think that's probably our window of opportunity right now, and until the Fed starts lowering rates. And I mean, we already saw this past week or so Blackstone making the $10 billion acquisition of that REIT. That's really the signal that everyone's been waiting for, institutional money to jump back in.
Yeah.
And the market sees it as a signal of the bottom. So that's huge. And with that, our window of opportunity is closing. So we're really focused on acquisitions right now, and trying to nab some of those lender owned, ideally, or just for sales.
Mm-hmm. Yeah. The I think that's a great point, bringing up that large investment. It definitely signals shift. How long that's going to take, right? Like those large
Yeah.
REITs have time to kind of, um, they have investors that sort of manage that liquidity for them. But yeah, for you as an operator, what do you think kind of sets you apart from in terms of, hey, I'm trying to attract more investors. Here's your chance to tell them why it should be you.
Yeah. So I think at this point in the market, especially, there's a lot of big groups that may just acquired a ton of property, and and they weren't able to exit nearly enough of that. And so what makes us unique right now, leading up to 2023, we exited just over 40% of our portfolio. In 2023, we exited another 40 plus percent of our portfolio. So 75% of what we own right now, we bought last year. So, we don't have just a ton of fires to put out. We're not trying to, just play damage control on the portfolio. We're focused on improving our processes, getting better, streamline operations, and, find more quality assets to buy.
Yeah, no, it's a great point. I mean, there is we can't time the market, but certainly sort of being aware of what's going on and trying
Yeah.
to be nimble and hopefully staying out ahead of it is going to
Yeah.
be, you may not time the exact bottom and you may not time the exact top, but looking for those signals that
Yeah.
here we are at
And
the
that
bottom.
was, yeah, that was all, that was mostly luck. I mean, we're IRR driven, so we're going to try to get in and get out as quickly as we can. But now we've seen that's one of the benefits. We didn't get caught holding the bag. We locked in our gains, 1031 into the next deal, and
Yeah.
now we're really glad we did. So worked
Yeah.
out.
Yeah, I think, and it's a great message for people who are considering investing, even as passive investors. Is we've when everybody, it's that whole Warren Buffett thing: be greedy when others are fearful, and fearful when others are greedy. Because you know everybody was jumping in 2 years ago, and looking back in time, you could say maybe that wasn't the right time to jump in, and realistically now probably is. And so I think it's just shifting that mindset around investing, and what you're really, you're looking at it as a ultimately a long-term play. So um, yeah, very cool. Well, David, let me switch gears so I can ask you the questions I like to ask every guest. The first one, of course, being related to the name of the show. What is your why? What's driving you? You've got a ton of really great experience under your belt at this point. So what's driving this growth?
As I started getting a little older in life, I started to kind of figured out that what I was really craving was freedom, and you can't really be free until you're financially free. So that's initially why I got into this industry, and then having kids and a family has kind of amplified that. There's a lot of safety and security in being financially free and not dependent on anyone else for income.
Yeah,
So that's my main driver, honestly, right now. Success. Money's just the measure, but
yeah,
financial independence, security.
yeah, yeah. And creating that freedom and control of the
Exactly.
future is so
Hmm.
important. Well, tell us something about yourself that isn't common knowledge. Special skill, a hobby, something to let listeners know you a little better.
Hmm. Well, as of this past weekend, I'm pretty adept at building a chicken coop, so that's new. Uh,
Nice.
yeah, didn't foresee that 5 years ago, but no, it was great. We've got chickens and rabbits and all kinds of stuff now. So my wife, I don't know what my wife will bring home next week.
Yeah, yeah. Well, that's it. Add kids into the mix, and that stuff starts to
Yeah.
stuff you never thought starts popping up. No, that's awesome. It's funny you say it, like I would love to have chickens. Like I like fresh eggs is one of my
We're
favorite
excited. Yeah,
in
we're
the world.
excited about it.
And we unfortunately that's the downside of living in LA is we're in theory not allowed to have a chicken. It would too close to everyone around us, and they would be too noisy. But
Oh, really? Yeah. Yeah,
Yeah,
we
that's
even, I mean,
definitely on
before we
my list.
moved out of Dallas, we even planned to have them here. You just can't have roosters in the city, but you can have hens. So yeah, that's interesting.
Yeah, I think there's just different, different municipalities have different regulations, but
Yeah, yeah.
I love the idea of having chickens. I'm sure the kids could love it as well. So I'm a little jealous that you got to build a coop. When people hear this and they want to reach out to you, what's the best way?
You can um, you can find me on LinkedIn, David Lilley, Lilley. Also visit our website, reapcap.com. So reapcap.com. There's contact form page on there, and also my Calendly. So you can go on there, schedule a call directly with me or my director of investor relations, and yeah, feel free to reach out.
Awesome. We'll put that in the show notes so people can find you. Last question for you: what piece of advice would you give to someone who is wants to get started in real estate? Kind of hear your story, your success,
Mm-hmm.
and they're interested. What would you tell them?
I would tell them, really, there's no difference between you and me. The only difference, maybe depending on if you haven't gotten started or not, is is what you were okay settling with. I wasn't okay just being a firefighter, so I decided to kind of change my financial position. So just showing up and doing the work, and yeah, it's gonna require taking some risk, that's for sure. So if you go down this path, you better make sure you're willing to take on a little risk and do a lot of work because it's a lot of work.
Yeah, yeah, yeah. That's the big the big two for active real estate investing. A lot of work and a lot of risk. There's there are other ways in. You can be a passive investor, no work, and still some
Yeah,
risk, a lot
yeah.
less. So no, that's great. Well, listen, thank you for coming on the show today. It's been awesome hearing your story. I think it should be very inspirational to a lot of people. So thank you for taking the time out.
Thanks for having me, Jason.
Yeah, and folks listening, I know you're going to love this episode. Please like, rate, and review the show so we can get more great guests like David and connect with him on LinkedIn.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?